Good day. It is Monday, November 4th, 2019. Thank you for joining us here on YouTube. Let's jump right into it today. We're going to talk about ghosts of Halloween's past. I'm sure you have studied at some point in your trading career October of 1929 and October of 1987 and the September-October period in 2000 and the September-October period in 2007. That last one being 2000 and then 2007, and now we're in the September, October, November period of 2019, which ranks right up there with them. In fact, maybe is the granddaddy of them all in times of spooky periods and what lies ahead. If you walked into a shopping mall and looked for the map and stood in front of it, you'd find a place on that shopping mall on that map that says you are here, and there'd be an X in that spot. That X marks the spot where you're standing and shows you where you are in relation to the all of the buildings and businesses around you within that mall. If we did that for the stock market and marked on the 2006 to 2009 Standard & Poor's chart, the spot that most perfectly corresponds to right now, that time would be October 11, 2007, and I marked that you are here, X, just as if we're looking at a map in a mall, because that's where we are. Full stop. So that's it. That's all you need to know. You can go on about your business today, or you can stick with us for another 10 or 15 minutes. We'll explain how we came to that conclusion. We look at three main things when we look at the market. We'll look at trader sentiment to tell us where we are in the big picture of things. Are we near a bottom? Are we near a top? Are we somewhere in between? And trader sentiment is how bullish or bearish investors are. By definition, investors are most bullish. Their expectations are greatest at the top of the cycle, and their fear levels, their perceived risk levels are they perceive the risk levels to be the lowest when we are at the top of the market. So at the top, they see only up, no risk. At the bottom, they see the opposite, only down, no opportunity for profit. People are most bullish at the top, most bearish at the bottom, and if we look at the period 2017 to 2018, we will see the quintessential example of a major market top. We've written a couple of articles about that, one entitled Rainmaker, another entitled When Worlds Collide. If you go to sevensentinels.com and go down to the bottom of the page, you will see a number of articles down here that you can click on and read, and they're free. All you have to do is go to Seven Sentinels, click on these. You don't have to be a subscriber to read these articles. One of them is When Worlds Collide, another is Rainmaker, and they explain how 2017 and 18 were the quintessential example of a major stock market top. We believe that 100 years from now, literally, people are still going to be talking about the 2017-2018 market top because of the extreme excesses that were screaming at people, telling them that they were at a market top. And speaking of these articles down at the bottom, the one at the very bottom is entitled You Are Here X, and it is the notes of this particular video that you're watching right now. And if you want to go to that article later, you can see all these charts that we've talked about and review them. And it'll be a kind of a recap of everything that we've talked about here in these few minutes together that we're spending. Going back now to where we were, here was the 2006 to 9 market. You are here, full stop. Trader sentiment, market momentum, line of okay, we were talking about sentiment and the articles that we just pointed out will detail those sentiment. The next thing we look at is market momentum. When markets are advancing, the strength of that advance tells you where you are in the cycle. When the market is going up and it's got a strong push behind it, you know you're in safe territory, you know that you're in a good trend and you can stick with it. But as the momentum starts waning, dropping off as the market is making new highs, you know you're getting towards the top. We wrote an article yesterday called When I'm 64, because when the RSI hits 64 after a whole, on both the daily RSI and the weekly RSI, for a whole cycle at a new high on the Dow, that's it. That's the top. Just like people get old, markets get old, and markets get old when they hit 64 on the RSI. Here is for the year 2000, 1999 and 2000. You see the Standard & Poor's here going higher and higher and higher and making new all-time highs. As it did so, the RSI, the Relative Strength Index, a measure of momentum, was 80 at this first high. A year later, when it made this new high, it was only 71, and nearly a year after that, in September of 2000, as the S&P made its final high, that RSI was just 64. There's that number again. In 2007, as the Standard & Poor's went up and up and up and up, made new high, all-time high, all-time high, all-time high. The RSI was at 80 at this point. It was at just 72 at this point, and it was just 64. There it is at the final top. Now let's go down to 2019, as the Standard & Poor's has made a new high in January of 2018, another new high later in 2018, another series of new highs in 2019. The RSI readings were 90 back at the beginning, and then 75, 72, 71, and lo and behold, 64. So there it is. That's one good measure of momentum, the RSI on a daily and weekly basis. In fact, here it is on the weekly basis, same thing, new highs all the way along on the Standard & Poor's, and here are the readings on the weekly RSI: 80, 75, 74, 70, 67, 66, and then 58 was the low at the final top in the year 2000. In the year 2007, again, new high, new high, new high on the weekly, and the RSIs on the weekly were 74, 71, 64. There's that magic number. And right now, as the Standard & Poor's made a new high, a new high, a new high, a new high, all the way through here over the last 21 months, we saw readings first of 90 at this peak, and then all the way down to about 68, 67, 66, and then 63 at the most recent top. In fact, today it's 64 with the pop-up in the market, which we'll see how that stands up as a final high, but we're somewhere in that vicinity, as all this is telling us. Another way of measuring momentum is we can take a look as the Standard & Poor's is going up. Look what happens to the Russell 2000 in the last part of that move. As the S&P makes a new high, Russell 2000 significantly lower. As the S&P makes a new high, the transportation average massively lower in the year 2000. Then look at 2007, as the S&P is making new highs, the Russell 2000 significantly lower, transportation's massively lower, transportation's up again lower. That was the RSI, I'm sorry, and the Russell and the transportations. And then in this cycle, even the New York Stock Exchange Composite Index fell substantially at the end of the move. So that's the pattern. We see it over and over and over. We've seen it this time. We are there. Full stop. Everything has fallen into place. Finally, of those factors that we use to study the market, the third one we use is the line of least resistance. That's a term that we took from Livermore. He called the line of least resistance the direction of the market. He always traded in the direction of the market with the line of least resistance. And you may know that in the 1929 and 30 markets, he traded that line of least resistance from near the high in 29 all the way through that bear market, and turned what started out in the 1990s as $5, literally, into the equivalent today, in today's dollars, of $1.2 billion. That's with a B. Livermore said that once he learned to trade properly, that millions came easier to him than hundreds had in his days of ignorance. His days of ignorance were before he understood about the line of least resistance. Once he understood that his job is to align with the line of least resistance and just ride that market trend, that's when he made the real money. And he said that over and over and over in his writings. So what we did over the period of time after we first learned all about Livermore's methods was we began searching for a way to know what the line of least resistance is. How could you measure it? How can you quantitate the line of least resistance? And what we came up with finally in the year 2000 was our index called the Seven Sentinels. The Seven Sentinels are a way of defining the line of least resistance. And we're not going to go into their whole construction today, but we'll just say briefly that we use the seven are the moving averages of these seven factors: the McClellan oscillator, the McClellan summation index, the NASDAQ, the McClellan oscillator, the NASDAQ summation, the inverse VIX, the inverse VXN, and the BP comp. We use moving averages, and when the short moving average crosses the long-term moving average for each one of those things, that particular trend measure goes into a buy if it crosses upward, or a sell if it crosses downward. When all seven cross upward, you have a buy signal. The market will then stay in an uptrend. The line of least resistance is up. It will stay up in an uptrend until all seven cross downward. And that's what the Seven Sentinels are. That's what the line of least resistance is. And you already know how Livermore used it to make the equivalent of $1.2 billion. Thursday night, when we put these numbers together and put them onto our website for this presentation, we showed these Seven Sentinels in our 2-hour time frame. This is the McClellan oscillator and the McClellan summation index, both in downtrends. This is the NASDAQ McClellan and the NASDAQ summation, both in downtrends. This is the inverse VIX in a downtrend. This is the inverse VIXN in a downtrend, and this is the BP comp in a downtrend. All seven went into downtrends on Thursday. Friday and Monday, we got a strong seasonal move from the November 1st and 2nd, or 1st and 2nd days of November being the strongest days of the year, and from the jobs number. We're still feeling that now, but the interesting thing is, in spite of all this strength in the market that we're seeing today, that line of least resistance still remains down. This 400 to 500 Dow point rally has not been enough even to reverse the line of least resistance. It's still down. This is a counter trend rally. full stop. So that's where we are. If you go to our website, you can read those articles. You can read the notes of this discussion today, or you can go to a link that says limited time trial. And in kind of celebration of this video and this period of time right now, we're running a limited time special for 5 days where you can try out 7 Sentinels yourself for just $4.95 for 5 days. You can see everything that we publish during the day, each night, in the weekend. All of our signals, all of our trades, everything is there. And for $4.95, you can give it a try. Just click on that limited time trial link. Thank you for coming by today. We appreciate it, and we want to wish you good trading.